and a very happy new year to all of you. January is a natural moment to pause, reflect and reset. Not just in life, but in markets as well. The year gone by was not about excitement. It was about resilience. Growth held up, inflation cooled, and markets spent a long time consolidating. Historically, these quieter years often prepare the ground for what comes next. So today, let's look at how last year ended, what December specifically told us, and what that matters as we step into the new year. Hi, I am Saurabh Srivastav from the research team at MFA, and you are watching Story of the Markets. Globally, the year ended on a fairly steady note. Growth did not collapse. Inflation continued to ease, and central banks moved closer to balanced stance. Markets were not euphoric, but they were stable, and that matters. Sustainable rallies usually emerge after consolidation, not excitement. Now let's zoom into December. In the US, interest rates were cut, yet bond yields moved higher. That may sound confusing, but the reason is simple. Economic growth surprised on the upside, and the markets began to believe that aggressive rate cuts may not be needed going forward. Inflation continued to cool, while activity indicators softened slightly. This points to a gentle slowdown, not a breakdown. There were also geopolitical headlines around possible peace talks. Markets reacted calmly, having learned that headlines matter less than the outcomes. Japan raised interest rates, which many feared could disturb global markets. But markets absorbed it calmly, reflecting underlying resilience. December was strong for commodities, especially metals. Gold and silver continued their uptrend, supported by a weakening dollar, strong industrial demand from EVs and AI, and steady central banks buying. That said, metals are cyclical and influenced by factors beyond our control. They are best viewed as diversifiers, not return drivers. Oil, on the other hand, remained range-bound, supporting no major supply or demand shocks. Back home, India's domestic picture remains relatively strong. Economic indicators point to steady demand, policy support, and controlled inflation. While foreign investors were cautious, domestic investors continued to show confidence. This internal strength remains one of India's key advantages. Of course, risks remain. Geopolitical surprises or a stronger global data could lead to short-term volatility. These are the risks to be aware of, not reasons to panic. Looking ahead, markets are now waiting for triggers. Corporate earnings are expected to improve, helped by a favorable base. Markets have been consolidating for a long time, and a positive earnings surprise or a policy clarity could help break that range. The union budget will also be clearly watched, especially for spending priorities that can revive both rural and urban consumption. To sum it up, last year ended with stability, not stress. December reinforced that global growth is slowing gently, not breaking. India remains relatively well placed. This is not the time to chase noise. This is the time to stay diversified, focus on quality, and let fundamentals do the heavy lifting. Markets reward preparation, not prediction. Stay invested, stay diversified, and let time, not headlines, do the real work in your portfolio. Thank you.